Hello and welcome to the Margin of Sanity podcast. Today we're going to talk about OTC Markets Group, ticker symbol OTCM. I'll break down what they do, how they do it, and what sorts of financial figures this business actually produces. This is a relatively small $600 million market cap company, which I do already own, and I'll be looking to add to the position if the price falls a little bit. Thanks for checking out the Margin of Sanity, and if you're listening on a podcast player like Spotify, YouTube, or Apple Podcasts, just know that this entire write-up is available totally free on the Margin of Sanity Substack. If you're enjoying the show and you want to show a little love, drop a like, a comment, or a 5-star review. That engagement really does help me out, and it helps other people find the show. And head on over to the YouTube channel if you want to watch a walkthrough of this company. If it's helpful, let me know, and I'll keep those coming. All right, enough of that. OTC Markets Group, the cash machine. Let's dive in. OTCM stands for over-the-counter markets. And if you're into nano-cap value investing or anything like that, then you've almost certainly used their platform before. I say platform, but this is much more than a simple platform. OTCM's business took me a minute to get my head around, but once it clicked, I got pretty hungry to buy at least a little bit of it. It's my smallest position, but I do own it, and I really think it's quite a good business, selling for a very reasonable price. A few financial figures that got me interested were a 93% gross margin, 25% net margin, return on equity of 70% or higher, zero long-term debt, cash on hand $32 million on a market cap of $675 million and net income of about $26 million on the low side. Trailing 12 months PE ratio of 25 right now, and it was 20 when I bought it. That's a current pre-tax earnings yield of about 4.8%. Already, I'm interested. This appears to be a capital-light and well-managed company with no debt and fantastic quality metrics. For example, high return on equity and margins. There's also some plausibility that it's actually overlooked because it's a small company. $675 million market cap. But we got to go way deeper than this. So what do they do? Part 1, the business. Okay, let's start with the OTC markets themselves. For decades, extremely small companies and many foreign stocks have traded on something called the over-the-counter markets. These securities were called pink sheets, and they were, and still are, somewhat out of the scope of the typical retail or institutional investor. I think of the OTCs as a sort of thrift store. There's plenty of junk, but there's also some real treasures if you know what to look for. In fact, my secret position, paid subscribers only, trades on the OTCs, as do many small banks, insurance companies, junior miners, small retailers, and all sorts of other random and small US companies. Remember the Wolf of Wall Street? Yeah, well, in the beginning, they're running penny stock scams on the OTCs, the pink sheets. Why? Because those are the least liquid stocks and the easiest ones to do a pump and dump. It's like the Wild West over on the pink sheets, or at least it used to be. The other sort of business you'll see trading OTC is the stocks of medium and large foreign companies who don't want to deal with the expense and regulatory rigmarole of listing on the NASDAQ or NYSE, New York Stock Exchange. Basically, these foreign companies, for example, Samsung, Nestle, Roche, Tencent, Volkswagen, etc., are already listed on a major exchange in their home country. Under US law, since they are already compliant with a major exchange, they are also in compliance with the SEC, and their shares can trade legally in the US. That doesn't mean that they can just list on a major exchange, though, nor do they want to. Why? Well, reason 1, there's loads more paperwork and cost. Compliance is expensive. A U.S. listing means Sarbanes-Oxley international control tests, quarterly SEC reports, and audits that follow stricter PCAOB rules. Even a giant like Samsung would be writing several $1 million a year in checks just to stay compliant. Crazy. Reason 2, bigger legal target. U.S. exchanges plug you straight into America's shareholder lawsuit machine. One earnings miss or governance slip can trigger a class action suit, something many foreign boards would rather avoid. Reason 3, governance rules that don't match home country practice. NYSE and NASDAQ insist on things like a majority of truly independent directors, specific audit committee powers, and clawback policies. Firms that already satisfy tough local rules, say in Zurich or Seoul, see this as a hassle with little upside. And reason 4, they already have deep liquidity at home. Samsung, Nestle, or Volkswagen can trade billions of dollars already a day on their domestic exchanges. In short, a US listing gives some prestige, but for many huge non-US blue chips, the extra fees, rules, and lawsuit risk usually outweigh the benefit. So basically, it's just an expensive pain in the ass to properly list. Enter the OTCs. With the OTC markets, foreign companies can open themselves up to the US markets for less hassle and cost. US investors can trade those shares in US dollars instead of a foreign currency, saving money and building in a currency hedge. There are some other advantages to buying foreign stocks on the OTCs, but suffice it to say it's definitely the way to go if you're a US investor. It's a win-win for everyone. For the other segment of the OTC markets, i.e. small US companies, the issue is similar. It costs big bucks to list on a major exchange, and most smaller companies just can't afford it. What they definitely can't afford is the compliance costs. If I've learned anything from researching this company, it's that compliance is expensive. The OTCs offer small US firms a bridge between illiquid private markets and full-on public markets. If you're the CEO of a $100 million company and you want to sell some shares to pay for, a divorce or a new house, or both, you aren't going to take the company to the NYSE just to get some liquidity. You also don't want to let the private equity foxes into the henhouse, and so the OTCs are a great middle ground. All in all, about 12,000 individual securities are quoted and traded on the OTCs. The yearly dollar volume of shares traded is about $475 billion. It's small, but not that small. Part 2. I thought we were talking about the business. Okay. So now that you know what OTC markets are in the first place, understand this. They are controlled entirely by one company, OTC Markets Group, ticker symbol OTCM. OTCM is not an exchange. Wink. But it's just about as profitable and important as an exchange. Provides very similar services to society and ultimately functions like an exchange, but it's not an exchange. So what is it? OTCM is 3 things. Thing 1, OTC Link ATS. ATS stands for Alternative Trading System, a pretty good descriptor of what it is. This business segment is what enables the trading to happen in the first place. It connects buyers and sellers, broker-dealers, and collects all the info from those trades, bids, asks, volume, price, etc. It's the plumbing of the entire operation. Back in the day, many phone calls had to be made for these types of securities to be traded. Today, that same process happens in seconds and sometimes automatically thanks to OTC Link. And OTC Link is, of course, owned by OTCM. So when you go and click buy on an OTC stock, your broker shoots that order into OTC Link ATS, an SEC-regulated electronic chat room where about 90 market-making broker-dealers are already flashing the prices at which they are willing to buy and sell. The system is not a central exchange. Instead, it's a qualified inter-dealer quotation system. So every quote is, quote-unquote, attributable. You see exactly which dealer is on the other side. Your broker either hits the best displayed ask price or sends a quick message to negotiate. When the market maker answers done, the trade is locked, instantly timestamped, and both firms report it to FINRA's OTC reporting facility. So it prints to the public tape, usually within 10 seconds. A day or two later, the shares settle through the same DTCC plumbing, which is just clearinghouses, that listed stocks use, and the position shows up in your account, all without anyone ever touching a traditional exchange floor. It's not an exchange. Wink. So how does this segment make money? First is the monthly public subscription from broker-dealers. About 140 broker-dealer subscribers pay flat subscriptions each month to plug into OTC Link, post price quotes, send electronic trade messages, and keep the network lights on. Think of it as rent for a trading terminal. Next is the per-share execution fees on its ECN, Electronic Communications Network. When those dealers actually match orders inside the OTC link, OTC Markets charges them a sort of transaction fee. This is relevant because sometimes sheer market activity can move the needle on this portion of the business. More trading equals more money. And finally, we have connectivity and reporting add-ons. Dealers that want high-speed financial information exchange gateways, dedicated lines, or automated trade report filing pay small a la carte fees. These tools and add-ons help brokers improve their services to clients and make a bigger profit. The dealers themselves make money the old-fashioned way, by earning the bid-ask spread on each OTC trade and pocketing any retail commissions. All of this together equals about 20% of OTC's $111 million of revenue in 2024. Okay, that was thing one, OTC Link, the trading plumbing. Thing two, market data licensing. As you might imagine, all of this trade data is crucial for people to access in order to, for example, know the price of the shares. They also collect financial data about the companies, net income, market cap, shares outstanding, etc. OTCM owns the trade data at least, and they license the access to that data to, well, anyone who might need it. Customers include Fidelity, Schwab, JP Morgan, Seeking Alpha, Yahoo Finance, and regulators in need of that data for compliance info. The customers fit into four main buckets. For example, I may research a company on Seeking Alpha. Say I do a market screener for a company with a PE below 20 and a market cap below 100 million. Right off the bat, that financial data Seeking Alpha, Yahoo Finance, Guru Focus, etc. is using to show me the company, that's OTCM's data. When I actually click on the company and look at the price chart, I'll see real-time bid-ask data with a quote for the stock price. This is also OTCM's data, and it's available to these customers often with about a 15-minute delay. All of that is bucket one. Then I go to my Schwab, my Fidelity, my Bloomberg, etc. to actually buy or sell the stock. The info I see there, that's bucket two. Then I want to buy it, and perhaps on the other side of that trade is Jane Street or some other trading house, JP Morgan, Citi, Virtu, who needs the data at lightning speed in real time. They're in bucket three. And finally, perhaps that company is in violation of reporting regulations. And that info is also reported and owned by OTCM and would be consumed by law firms, attorneys, and regulators. That is bucket four. This market data licensing segment is extremely high margin revenue because OTCM has that data already, and they're profiting on its collection. All they have to do is resell it and presto, free money. This is the largest portion of their revenue at about 40%. And finally, thing number three, corporate services. As you might imagine, something is missing from the equation, and that's the companies listed on the OTCM in the first place. This ain't free. OTCM, which is not an exchange, wink, offers their corporate customers, the small banks, miners, foreign companies, etc., access to public markets. In exchange for that access, they collect a one-time signing bonus as well as an annual subscription. Your tiny company that you want to list on this platform can choose from about 4 different tiers. They vary in their compliance needs as well as their costs. The more quote-unquote legit tiers give you more liquidity, but also come with a higher price tag and compliance needs. For example, you would have to furnish audited quarterly earnings on the high tier, which is OTCQX. But you don't really have to report anything on the lowest tier. That's the pink tier. I'll take this opportunity to mention I have a walkthrough for a lot of this stuff on YouTube, and for what's coming up, the visuals might help you a lot. And there's also a write-up that's available totally free on the Margin of Sanity Substack, so maybe just go check that out. Okay, moving on. The pink tier is also divided into 3 categories, one of which is called the gray market or expert market, where you're not only dumpster diving, but you're doing so in the dumpster of a broken glass factory. Some of the new developments at OTCM itself has been the advent of OTCID, which is a new tier meant to replace the highest tier of the pink market. More on that later. Along with the listing fee and subscription, corporate services includes other upsells for clients, including Level 2 data, regulatory compliance tools, OTC disclosures and news services, and even virtual investor conference tools. Okay, so those are the three things OTCM does. We have OTC Link, we have market data licensing, and we have the corporate services. Notice how they all flow into one another beautifully. The more companies that list, the more brokers trade, the more data gets licensed. Ultimately, the success of one segment feeds on the other. And this I absolutely love. It's all capital light, and the moat may look shallow, but it's really deep. Why would any companies list on an exchange that no one trades on? And why would brokers sign up to trade on a platform with no companies? OTCM has the market cornered. And even better, they don't have to engage in any kind of anti-competitive practices to hold on to their position. Moreover, they're always in good graces with regulators, since their platform makes regulation easy. Part 3. Financials. Okay, this part I definitely recommend heading on over to the Substack to follow along, because I got some really cool interactive charts. It took me forever to make them, but I'll try to walk you through this on audio here in case you're out walking around or driving and you can't look at a chart right now. First, let's take a look at OTCM's revenue by segment over the last 10 years. I'll also mention again, Margin of Sanity's YouTube channel has a walkthrough with charts and all of that for you. So go check that out if you prefer a more casual video-style learning experience. Okay, first up, we can take a look at OTCM's revenue by segment over the last 10 years. For those just listening, the graph depicts steady revenue growth up and to the right pretty much until 2021, when total revenue spikes from about 70 million to over 100 million in just a single year. The top line then continues pretty much just growing until 2024, albeit at a slower rate. That spike in 2021 is due to the retail frenzy. Remember in the meme stocks and all the hype around investing? Yeah, well, that hype went straight to OTCM's top line, primarily from OTC Link collecting more trading fees. But the corporate services and market data licensing segments also saw a surge in business. Naturally, that boom created, well, not a bust per se, but more of a hangover. Net income has actually declined slightly from 30.8 million at its peak in 2022 down to 27.3 million in 2024. I'm fairly confident this is more of a pull-forward effect than anything, and moreover, the company has made a push to expand the business in recent years, and I think we'll begin to see the positive results of that this year in 2025 and into 2026. Moving on to operating cash flow. Once again, I definitely suggest taking a look at the YouTube video or just the Substack write-up for this financial segment. The only real thing to note with cash flow is that it's usually higher than net income, and that is more of an effect of stock-based comp than anything else. I should mention that while the company does use a fair bit of stock-based comp, they also spend about the same on buybacks to offset that amount. So in the shares outstanding chart, you'll see there's virtually no change in the share count. Next up, we have the margins segment. OTCM's gross margin is basically anywhere from 93% to 100%, as it's a service business that doesn't really need to spend much to make a lot. Naturally, the operating expenses are where we start to see margins get a bit more realistic. Operating margins have reached as high as 38% in 2021 and currently sit at 29% in 2024. Still a fantastic margin. If you're wondering which operating expenses are actually eating up that giant gross margin, it's mostly going towards talent. This is by far the largest expense category. This reflects the nature of OTCM's business as a financial technology and market services firm. It relies on skilled employees, technology developers, market operations, regulatory compliance staff, etc., to drive the operations and the growth. Management has noted the need to attract and retain talent with competitive pay and benefits, especially to develop new services and meet regulatory obligations. The CEO, who owns a majority stake in the company, by the way, was paid $733,500 in 2024, and that included salary and stock. Next up, we have return on equity, sitting at 70% in 2024. Considering that this company has zero, I'll say it again, $0 in long-term debt, I'd say this is a fantastic return on equity. They hold roughly the same amount of cash as they have in deferred revenue liabilities, and so there isn't any financial engineering here from where I'm sitting. This is clearly an extremely capital-light business being managed as a lean, mean cash machine. Next, we can check in on capital expenditures. CapEx is very low for this company considering they generate so much net income. 2024 net income was $27.3 million versus only $1.3 million in CapEx. In 2021, the CapEx jumped to $5 million due to quote-unquote one-time projects in 2019. Roughly $2.9 million was spent on leasehold improvements and IT build-out for a new corporate headquarters, and another $2 million went into significant upgrades of the primary and secondary data centers. This strikes me as all very necessary spending and totally checks out in my book. As mentioned earlier, shares outstanding are mostly flat. OTCM chooses to return cash to shareholders in a different form, which leads me to the next section, dividends. In this next graph, I have dividends relative to cash flows. For those just listening, what you'd see is that dividends are usually about 60 to 80% of cash flows. It's almost all just coming right back to the shareholders. Suffice it to say, they're paying out a substantial amount of dividends each year. A note on dividends, though. They pay a regular dividend as well as a quote-unquote special dividend at the end of the year. The total yield is somewhere around 4 to 5%, although it will show up differently on Seeking Alpha since most platforms only track the regular quarterly dividend. Next, we can head on over to the balance sheet and take a look at the company's assets over time. Nothing much to note here besides a very healthy amount of cash always sitting on the balance sheet. This dry powder helps management avoid using debt down the road if or when they make strategic acquisitions and upgrades. There is a leap you'll notice in goodwill, which happened in 2022. Goodwill rose to $3.98 million. Almost the entire $3.73 million increase came from the May 2nd, 2022 purchase of Blue Sky Data Corporation, a provider of state Blue Sky compliance data. Overall, goodwill is well within a reasonable range. OTCM is by no means a serial acquirer or anything like that. Next, we can check in on the liability side, and yet again, we see such a responsibly managed business. You'll notice that deferred revenue is the largest of all the liabilities on the balance sheet. And this is more of a feature than a bug. OTCM's clients often pay in advance for their subscriptions, and that quote-unquote service they've paid for has yet to be provided. Hence it being constituted as a liability. Considering that most of their cash is spent on the compensation line item in operating expenses, I don't see this as an issue whatsoever. If anything, it's good because they get their cash up front. The next large item, operating lease liability, on OTCM's balance sheet represents the present value of future rent payments for its office leases. Principally, its New York headquarters lease extending through 2031, recorded under new lease accounting rules effective in 2019. You got to pay the rent. No big deal. In summary, this is an awesome financial picture. No red flags that I can see, and just incredible figures. Maybe I'd prefer buybacks over dividends, but all in all, I can't find anything to complain about. And valuation is totally within reason. Low to mid 20s, trailing 12 months PE, free cash flow yield of about 4.5%. I mean, hey, I own it. But why didn't I buy more? Part 4, organic growth. So far, OTCM has grown their business at a solid clip considering how little money they've spent doing so. Top line grew 10.3% compound annual growth rate from 2010 to 2024. Earnings per share grew even faster at 16%. The question I have to ask myself is, where will the future growth come from? It seems to me this isn't as clear and obvious with OTCM as it can be with some other businesses. For example, TSMC can grow earnings because, frankly, the world always seems to need newer and better chips, and more of them at that. More devices have CPUs and GPUs than ever before, and TSMC can manufacture those better than everyone else. Plus, data center growth and AI doesn't appear to be slowing down, and TSM is a critical part of that development. This is a clear growth case that I think anyone could understand. OTCM's is a bit more murky, so let's get into it. Growth path number 1. More volume over more time. 24-hour trading ATS. The demand to buy and sell securities doesn't end when the US markets close, particularly in regions other than the US East Coast, such as the West Coast, Europe, and Asia. To meet this need, OTC markets have invested in digital infrastructure that will enable them to offer overnight trading. This not only means better service for customers, but the move should also increase overall trading volume. More volume equals more fees, and we already saw in 2021 what more trading volume can accomplish. Don't forget, a boost to one segment of OTCM's business almost mechanically becomes a boon to the rest. Growth path number 2. Introducing OTCID, Corporate Services. Earlier, I mentioned the 4 tiers: OTCQX, OTCQB, OTCID, and the pink sheets. I also explained that the pink tier has sub-tiers within it, including a gray market. OTCID is a brand new development and is meant for companies currently in the pink tier who don't yet qualify for OTCQX or OTCQB, but do meet some reasonable SEC standards. This would exclude, shell companies and those who haven't reported anything to the SEC, the glass in the proverbial dumpster. While many companies on the pink sheets may just remain there, a good portion will graduate up to OTCID. Still, other companies who are not currently listed may be attracted to this new tier. Before, OTCM offered first class, business class, and in the belly of the plane with the luggage and the dogs. And OTCID is basically just coach. Not only will plenty of passengers happily move up to coach, but it's likely more folks will fly on the airplane in the first place, now that there is a proper place for them on the plane. This new tier will cost $7,500 a year, which is about $2,500 more than the pink tier, but still far less than the $16,000 to $26,000 it costs to sit on OTCQB and OTCQX, and a tiny fraction of the national exchange tab that can run well into the 6 figures for fees and ongoing compliance. Growth path number 3, compliance data, market data licensing segment. Imagine OTC Markets owns a library of information that brokers and fintech apps need every single day to stay out of trouble with regulators. After all, keeping track of the different laws in 50 states is not easy. In the last few years, OTC has been buying new shelves of books for that library and bundling everything into a single subscription that it can charge more for. Compliance data is must-have rather than nice-to-have, so OTC can charge a premium. Most of the cost of creating the dataset is fixed, so each extra subscriber is just pure profit. It's also a different sort of budget line item for the customers themselves, legal and risk, instead of the trading desk. So it's safe to assume those folks will fork up the cash. OTC's recent data buys, Blue Sky, Edgar Online, plus homegrown analytics, turn the company from a simple quote vendor into a full-service compliance backbone. In summary, more lanes, more gains. The beauty of this business is the flywheel effect. As one segment grows, so do the others. Each improvement to one aspect of their business deepens their already deep moat and also drives business to the other segments. By improving and growing each of these 3 spokes on the flywheel, OTCM is creating momentum, which, if all goes well, will turn into cash flow inertia, a term I just made up. What do I mean? Well, with the advent of OTCID, for example, they are attracting more companies to list on their platform. This, in turn, increases the amount of companies on the platform and therefore the amount of trading volume for OTC Link ATS. Moreover, it improves and widens the market data licensing portion as more trading equals more data. That growth is only multiplied by the move into the compliance data market. And all of this equals a better platform with more activity, attracting still more companies to list their shares. The addition of overnight trading appeals to foreign companies, and this in turn adds to the compliance needs of the brokers. Every good thing OTCM does becomes 3 good things later. And they're accomplishing all of this while returning a huge chunk of their cash to shareholders every year. Part 5. Down to Earth. In retrospect, I probably should have taken a bigger bite out of this company while it was selling at $47 a share. Today, it sells for maybe about $60 a share. But the reason I didn't had to do with the simple fact that it was just hard for me to wrap my head around the actual ability they have to grow organically with any notable speed. They can only do so much price raising before their moat is gone. Moreover, plenty of companies don't want to be public ever. There isn't a giant crowd outside OTCM's door demanding access. Instead, OTCM's growth strategy is more like Field of Dreams. If we build it, they will come. Now, that's pretty much worked so far, I should admit, and the giant pull forward in 2021 and subsequent hangover makes OTCM look like it's shrinking in recent years, when actually its core business is steadily growing, albeit in lumps. They can raise prices, but not much faster than NYSE or NASDAQ does, about 3% a year for the last 10 years. Another issue is the churn created by companies quote-unquote graduating to NYSE or NASDAQ. It also reminds me of the slogan for Hinge, the app that was made to be deleted. Of course, many companies listed on the OTCs will never scale to the size necessary to justify NYSE or NASDAQ listing, but we still do lose some folks along the way. OTCM claims this as a victory, proof that this bridge platform serves the companies who choose to list on it. And that's true to some extent, but it does sort of bug me. Perhaps we can take a look at some of these KPIs over the past decade or so. First up, we have dollar volume per tier over time. Here we're looking at the ATS trading side of the business, and dollar volume is a decent indicator of activity on the markets, and therefore trading fee revenue. You'll notice the pink tier is by far the most active and largest tier, hence the addition of OTCID this year. And the next annual report will likely have an OTCID column. Next, we can look at the overall number of securities quoted on each tier. This is an indicator showing a sort of midsection between ATS and the corporate services side of the business. Once again, pink tier is the largest. Since one corporate client can list multiple securities, it's also probably good to take a peek at individual corporate clients on each tier. This will give you an idea of the actual growth in corporate services. And if you're just listening, I will mention that the pink tier does have more individual corporate clients, but it's not as big a difference as the individual securities being listed. In other words, while dollar volume per tier may differ pretty dramatically, the actual number of individual clients on each tier is a bit more similar. In 2024, OTCQX had 567 clients, OTCQB had 1,050, and the pink tier had 1,338. Still the largest, but not by as large a margin. As I mentioned earlier, there are some clients who move on to the large exchanges each year. The below chart will give you a picture of the baseline attrition/churn rate for the corporate services segment. In 2024, 43 companies graduated to national exchanges. In 2023, that was 38. 2022, it was 74. The peak in 2021 was 155. 2020 was 66. 2019, 57. 2018, 70. You get the idea. They may lose some clients every year, but it's not such a major issue. And finally, we can take a look at the market data licensing side of the business. You'll notice a very small but growing market data compliance file users portion of the business. And you'll also see that non-pro users fell sharply after the retail frenzy, but the professional users just glided on by. I know a lot of people might just be listening here, but essentially, every year, the amount of individual customers for the market data licensing portion has grown somewhat steadily. There was a big boost to the non-pro, so you can sort of imagine that as retail section of that business back in the retail frenzy, which makes a lot of sense. And that died off. It's worth noting that the professional users actually continued to increase after the retail frenzy. So look, we can see this business is growing. Moreover, I'm quite bullish on the introduction of OTCID. I think it will not only drive new revenues straight to the bottom line, but I also think it will generate more activity due to the sudden viability of these securities that used to be scattered among junk. This would naturally increase the amount of trading and likely also increase the market data licensing side of the business. I could also imagine it will grow that tiny compliance portion of the market data licensing segment. Part 6. Conclusion. What I'm doing. I'm not going to lie. I regret not purchasing more of this when I had the chance. What stopped me was the combination of not fully understanding yet the growth story going forward and management's preference for dividends over buybacks. In my mind, this company was and is cheap, and so I honestly believe buybacks would be the way to go. I'll also note again that there is some key man risk here. The founder and CEO is by far the largest shareholder and essentially controls the company. The good news is that he's singing all my favorite songs. He talks about disciplined capital allocation and not wasting shareholder cash to try and impress on the top line. Ultimately, it seems as though management understands that this business is lumpy, and they're okay with that, as am I. It's not that much more expensive than when I bought it, but I find myself hesitating to sell anything else in order to buy more of this. At $60 a share, it's close to its all-time highs, and some of my other ideas, like Pool Corporation, Eagle Materials, AMR, HCC, are still just more attractive to me at these prices. Plus, I just like everything I own. Still, this business is awesome. The positioning is amazing. Basically, no real competition, and the economics are so nice. It's not an exchange, but it's definitely got every quality one loves in the exchange business. It's a royalty on public markets and trading for a very chill price. Capital returns to shareholders are the norm, and the balance sheet is clean as a whistle. So much to love, and I'll be keeping my eye on any price movement to the downside here. If it drops, I'll likely double my current allocation, depending on if I can find something to sell. I'll be watching the migration from Pink to OTCID very closely, as this is likely the most important indicator of how they'll do over the next 3 years. It's not an exchange, it's a cash machine. Thanks for listening to the Margin of Sanity podcast. I hope you enjoyed it. If you're listening on Spotify or Apple and you want to drop a like, a comment, or a 5-star review, that engagement really does help me out. And if you feel like you're interested in this but are still trying to digest some of the information, I do think a walkthrough on YouTube would help. And I also think taking a look at the write-up itself would help you. All those graphs, while they did take me a long time to make, were 100% worth it because even I feel like I understand this business better being able to visualize the numbers like that. The write-up is available totally free on the Margin of Sanity Substack. Thanks for listening, and I'll talk to you later.